football, the red zone is where a team has to make small adjustments to ensure victory. As you approach retirement, you also need to make small adjustments to ensure success. This is the Red Zone Retirement Program with registered investment advisor and enrolled agent John Mears of Mears Money Management.
Hi. It's time once again for Red Zone Retirement Program, Simple Investing, Smart Future with Coach John Mears. Coach, we're going to talk about tax mistakes new retirees might make. Because, hey, it's our first rodeo, right? So we might mess some stuff up.
Yes, yeah. And I see these things all the time. So, yeah, this is a good, great topic today to go over what new retirees are looking at tax-wise. That's also one of the biggest questions I get, too. And they still ask, and many are called but few are chosen. Let's just say that. So
very true, very true. Oh, we've got a Kiplinger article that we're kind of basing this chat off of. We'll throw a link to it in the show descriptions down below. People want to check it out. So basically, we'll start with ignoring the upcoming RMDs because it's your first. Again, it's like I said, it's your first rodeo. They've moved this stuff around a number of times now. The numbers have all changed. So, what's some things to be aware of? Should you be approaching that oh so fun, but yet somewhat dreaded RMD time?
Yeah. So RMDs, we know when they're coming. It's not some mysterious thing that's happening. It's written down. It's in black and white. Congress has written the laws. So if you're born in 1960 or after, the age now is 75. So we'll just use that as our benchmark, even though some people born before then are at 73. And as many of you know, the old rules, it was, 70 and a half, but now it's 75. We'll use that right now.
Yeah, sure.
A lot of people retire before age 75. So if you're retiring at age 65, we'll use that as a number. That gives you 10 years to plan for your RMD.
And that's required minimum distribution. Required being the operative word.
Required being the operative word here. It's not voluntary. Congress says you have to do it. So you have a required minimum distribution. And it's a divisor. So whatever dollar amount you have in your retirement plans, the first year is all rounded. It's actually a 26.4 or something like that, but we'll just say it's 25. So let's just use that as simple math. If you have $1 million divided by 25, your RMD is $40,000. So it is that simple. The math really is that way.
So you got to pull 40,000 out when you turn 75 that first year, right?
Yes.
Whether you need the money or not, because they want their money, and let's be honest, the government's broke. We need it.
Yes. So there's a divisor in there, and so you're required to do that. And Congress writes these laws because they give you the tax deferral before, the tax write-off before, and now you have to pay the piper.
Right.
The point that we're trying to make in today's episode is we're assuming you do know that this is happening, but you still haven't done anything about it. And I see this all the time where people are trying to do what Congress does, which is kick the can down the road. So if you're retired at age 65, if you want to do, let's just use Roth Conversions as an example, you have a 10-year runway here where you can do a lot of things, where you can kind of plan on how you're going to, what amount you may want to convert, and also what amount's going to be tax-free or tax-deferred when you hit 75. If it's tax-free, if it's converted to a Roth, you don't have any RMDs. So that's the beauty of the Roth conversion.
And that's the sticking point, Coach, right? Because people will often say, well, I don't want the money, but they're making me take it. And how do I get out of this whole paying the tax thing? Well, you don't get out of it. And somebody goes, well, what about the Roth conversion? Well, yeah, but you're still you got to pay the tax to convert it.
Yes.
Right.
And this all requires planning. And so this is what again, you'd be shocked how many people don't do anything at all about this. Not a little bit, but nothing. And they're turned 75 and they just, okay, what's my RMD? And that's an old tax guy. I just calculate it for them and pat them on the head and send them on their way. But there's so much opportunity here to figure out, okay, what can we do as tax-free? What can we do that will be, and sometimes you don't want to convert all of it either. That's a little too much for today's episode to get into, but there is a reason why you may not do all of it, but we have opportunities to plan and figure out what we're going to do when we hit 75, when the RMD age finally hits. So planning ahead is so important. Yeah. I in my old days as a tax guy, when I had my large tax practice, you'd be surprised how many people just came in and said, oh, here, I took my 2 RMDs last year because you're allowed to wait till April of the following year, April 1st. The following year. So people take 2 in the same year, and also they have this huge tax problem. We're going to get to some of the others here in a minute, but lack of planning is low hanging fruit. You don't have to have a 30 column Excel spreadsheet. Just at least get an idea of how you're going to do stuff and plan ahead.
And that's a good point, because you can bump it, right? And then you could take 2 in the next calendar year, but you do open yourself up to, to a higher tax bracket or whatever the case is, right? So, and you mentioned conversions. That's number 2 on this topic point. Not doing them at all or doing them wrong. Again, these are mistakes new retirees make, right? So you kind of touched on some of this a little bit, but yeah.
Yeah, so doing them wrong is also a problem, though. So so I had a client years ago who was super excited about the Roth conversions, and so they're all pumped up and they just did everything all at one time, and it was hundreds of thousands of dollars of a Roth conversion without any nuance. Now, what we try to do, folks, if we're trying to plan this out, and I'm going to oversimplify because everybody's different, but we try and max out your tax bracket. So if you're the 12% bracket, we try and fill that up before you get kicked into the next tax bracket. Because the whole point to a Roth conversion is to control what rate you're paying your taxes at. So we try and fill up whatever bucket you're in, because we're assuming that's where you're at. We don't want to be paying higher. Well, this person went from a 12 to a 24% tax bracket. It's like, well, they defeated the whole thing and they did it all without my consultation. Again, the exuberance was kind of fun and interesting to see, but they completely did it wrong. They blew the whole thing out of the water. And again, you pat them on the head, tell them, hey, at least it's tax free.
It's done.
Again, you probably didn't save any money here.
Well, it's tax free from now forward. Obviously you just paid a big chunk of taxes.
You paid a boatload of taxes just now, and probably at not the rate that we were desiring here. So you can Coach, do it wrong, people.
Yeah, for sure. And explain this a little bit in a little bit more detail for folks. So, and it's okay if you do bump a tax bracket, because not every dollar goes to that number. And again, that's where people don't understand. So if you are talking with an advisor and they are saying, okay, we're going to do some conversion, but you're already really, really close to going to the next bracket. Let's just say currently you're going from 22 to 24, right? It's not the end of the world to go up until it's 2%, right? $100,000, 2%. Well, that might be more than you want to deal with, but or $1 million, right? But you don't have to necessarily do it all. You're just going up incrementally. So if you do happen to go over, it's not like every dollar that you made at that point now moves to the 24, right?
Correct. But we want to make sure that whatever we're paying at 24, if plan it. Let's just say that. Let's do the math. A good advisor should have the software to do the modeling for this and figure out where you'll be at. Some of it has to do with really what your anticipation of is taxes in the future. And so whether you think that future President Newsom may increase taxes or not, you don't know. But we need to know, kind of if you anticipate paying higher in the future, that's what we need to plan on now. And there's some stuff built in the code. And I have a client right now where we actually know, even in current law, their RMD is going to be so massive, it's going to just kick them into a much higher tax bracket. Not a little bit higher, a much higher tax bracket. And we're really trying to encourage this client to do a little bit more in the Roth conversion arena. And it's hard though, folks. We know that you're writing a check to the taxing authorities. It's hard. It is. We know that, but you're going to be paying, like you were saying a minute ago, Mark, it's like the old Amco oil filter. You're going to pay them now or you're going to pay them later, but you're going to pay them. You got it.
Now, unfortunately, we try to make this show not too political, but because of that president comment, we're going to cut to commercial real quick. John's going to give me 50 up downs, and then we'll be back right after this.
Yes.
John has a couple of free books, Diffuse and Tax-Free Retirement in California, that reveal exactly how you can experience zero taxes in retirement and overcome the IRS lien on your 401k, IRA, and 403b, which could threaten your future lifestyle. These are complimentary, so all you have to do to pick these up 100% free is just stop by rescuemyretirement.net. That's rescuemyretirement.net. Fill in the basic info and he'll ship those out to you immediately. That's rescuemyretirement.net for a copy of Diffuse and Tax-Free Retirement in California. All right, Coach, wipe your head. You did those whip downs, up downs there. You're a little hot and sweaty, but you got it done. So
I ran 3 laps too.
Good job.
Good job. I'll call you when I need you.
Yeah,
I'll call you when I'm tired.
Had to punish him for that that terrible comment. It's a scary thought.
Yes,
just very scary thought. Back to our topic: taxes, mistakes for new retirees, blindsided by Social Security. We've done a bunch of episodes on this, but we're going to talk about it again for a minute.
Yes.
A lot of people, just don't even realize that Social Security is taxed, period. And then there's still a lot of them that go, but I thought they made Social Security tax-free. It's like, no, they made a senior deduction on the new changes. It did not make Social Security tax-free. But just in general, a lot of people don't realize that, Social Security gets taxed.
Yes, and we have a double whammy here. So that's what happens. So with your RMDs, let's forget the Roth conversions because we can manage through those. But when you hit RMDs, that can also affect your Social Security, your taxable portion of your Social Security. And I call that a double whammy because when you start paying more in taxes on your RMD or your IRA distributions, 401k distributions, it's possible now you're also paying tax on this other income unintended, and so you have two things are being taxed all instead of just one thing. And that kind of three, because then if that goes up, then your IRMAA surcharge is 2 years later. I was going to get to IRMAA. You beat me to the punch here. Yeah, I was going to say your income related monthly adjustment amount, your IRMAA surcharges also get factored into this as well. So,
but 2 years later, and you forgot about it.
Yes. So it's all some wonderful stuff. If you're not planning out your RMD years, you might be hitting 75. Let's just say you probably, because you were kicking the can down the road, you aren't aware that Social Security can be taxable. All of a sudden you start taking your RMDs, but all of a sudden now you have Social Security. Oh, wait, because you have this massive RMD, now your IRMAA surcharges are just jumped. And folks, it's not impossible for you to go from around $200 a month, whatever your current Medicare cost is, to $800 or $1,000. I've seen this happen. Just goes massively up. And that's per month, people. That's not for the year. So it's a huge, huge jump. And it's because people aren't paying attention. They don't know. They're not aware. And this is so easily planned out, and we can predict it and know. And let's just say this. Even if you had a high RMD and you did have an IRMAA surcharge, I always tell people, at least you know. Let's get the devil you know is better than the devil you don't know. We don't like surprises. So I can tell you, Mr. and Mrs. Smith, 2 years down the road, there's going to be a bump. And let's control what that bump may be rather than you getting the notice from Medicare saying, oh, by the way, and you start freaking out. So
yeah. I mean, nobody likes tax season. I mean, even tax people don't like tax season, right? And the rules change all the time, and so those are the big three that the article really addressed that we wanted to talk about, John, was again, ignoring the or not understanding RMDs, not doing conversions at all, or doing them wrong if that's on the radar. And then, of course, the Social Security taxation issue. Any other things to think about? Like they touch a little bit on forgetting to plan for the spouse.
Yeah, we'll talk briefly about this, but I've mentioned this in other episodes. If you are married, one of you is likely to be single at some point, and the tax brackets are compressed. It is possible, entirely possible. In fact, in many ways, probable you'll have less income and more taxes. If you don't plan this out, you got to know that, one reason why we're doing the conversions and just planning out what we're going to do is because there's a high possibility one of you is going to be filing at the single rate and maybe doing it younger than they had anticipated. So we want to know what's going on. We got to plan this out.
Well, and how do you do all that, right? So you get on somebody's calendar, you have a conversation, you start talking about some stuff. So if you need some help, go to bookachatwithjohn.net. That's bookachatwithjohn.net. Get yourself some time onto the calendar, or you can go to his main website as well. We'll have links in the show descriptions for you down below so that you don't make mistakes as a new retiree. Because, hey, it's our first time being here. There's a good chance we're going to screw something up, especially if you're not working with somebody, and of course, as all the studies out there show, a lot of times, there's so much technology and stuff that's helpful in a lot of the financial, planning space. However, it's experience and the behavioral management that you wind up needing a lot of the advice and the help from people who've done this day in and day out. And Coach is here to help. So again, click on the links below. Don't forget to subscribe to us on Apple, Spotify, and of course YouTube. And if you missed something, if we missed something, and you want to leave us a comment in the comments down below, go for it, and we'll talk about it on the next episode. Coach, thanks for breaking it down, buddy.
Thank you. This is a lot of fun.
Always appreciate it. Remember, be good, or you got to have to do those up downs, and nobody likes those either. Yes. So we'll see you next time here on Red Zone Retirement Program, Simple Investing, Smart Future with Coach John Mears.
Advisory services offered through Mears Money Management, Inc., an RIA registered in the states of California and Texas. California Department of Insurance License number 0685203.